Hello everyone, I'm Sabrish, Assistant Professor, Department of Management Studies, K.S.Rangasamy College of Technology. Now we are going to discuss about the capital structure. First, see the meaning. Capital structure refers to the makeup of a firm. Capitalization, in other words, it represents the mix of different sources of financing in long-term finance, such as equity share, preference shares, long-term loans, retained earnings in the total capitalization of company. A capital structure is defined as combination of equity and debt put into use by a company in order to finance the overall operation of a company. Debt and equity are the two primary types of capital source for a financing. First, we discuss about the short-term financing. Short-term financing means a business financing from a short sources which are for less than 1 year. The same helps the company to generate the cash flow of working of business and for operating expenses, which usually for a small amount. These are the four types of short-term financing. First one is a trade credit. It means the floating time of that allows the business to pay for the goods and services they can be purchased or received. The general floating time allowed to pay is 28 days. Next one is working capital loans. Banks or other financial institutions extended loan for shorter period after studying the business natures, like working capital cycles, records of the business. Next one is invoice discounting. It refers to arranging the funds against submitting invoice whose payment will be received shortly. The receivable invoice are discounted with the banks, financial institutions, or any third parties. Next one is an factoring. It is similar arrangement of finance like invoice discounting. It is debtor finance in which business sell their accounts receivables to a third party whom can call factor at lower rate than the net label value. It can be any type with resource or without resources. Next one is a long-term source of financing. Long-term source of financing means by loan or borrowing more than 1 year by issuing equity share or form of debt financing, long-term loans, lease or bonds. The source of long-term financing are equity capital, preference capital, debentures, term loans, and retained earnings. First, we discuss about the equity capital. Equity capital means the rate of return expected by the equity shareholders is higher than the debt holders due to the excessive risk they bear in repayment of invested capital. The equity shareholder have no preferential rights in the company dividend. They can carry higher risk across all the routes. Then next one is an preference capital. Preference shareholders carry preferential rights over equity shareholders in terms of receiving dividends at all fixed rate and giving back invested capital in company with the same amount of. Then third one is an a debenture. Debenture is a type of bond or other debt instrument that is unsecured unsecured by collateral. Since the debenture have no collateral backing, they must really on the credit worthiness and reputation of the business issues. Debenture holder can receive interest. Then fourth one is an term loans. Banks and other financial institutions generally give them more than 1 year. That is called as an term loans. They have mostly secured loan offered by the banks against a strong collateral provided by the company in the form of land and buildings, machinery, and other kinds of fixed asset. Next one is an retained earnings. The profit of company kept aside over time to meet company future capital means it means the free reserve which carry nil cost and are available free of charges without any interest. Next one is an factors determining capital structures. These are all some factors that influencing the capital structures of the company, like trading on equities and control over the business in the society. Nature of the business, it's like manufacturing or service sector or financing. It may be it is the nature of business. Then purpose of financing. Then period of financing, that is a long term or a short term, velocity of capital structure, then need of investor, cost of financing, and legal restrictions from the government or from the external bodies, then policy of term financing institutions, then possibilities of regular and fixed income. Next one is an capital structures theory. It is in order to achieve the goal to identify the optimum debt mix, it is necessary for the financing manager to become a conversant with basic theory underlying the capital structure of corporate enterprise. There are two major types of a capital structure. First one is a net working capital, and another one is a net operating income. First one is a net income, second one is a net operating income approach. These are the two major types of capital structure. First we discuss about the NI approach. This approach of a capital structure decision is relevant to the valuation of the firm. In other words, change in the capital structure cause a corresponding change in the overall cost of capital as well as total value of the firm. According to this theory, higher debt content in the capital structure will result in decline overall or weighted average cost of capital. Formula for the NI approach equal to V equal to S plus D. V refers to the value of firm, S refers to the market value of equity, B refers to the market value of debt. The second one is an NY approach. It means net income approach. This approach just opposite to the net income approach. According to this capital structure changes, market value of firm is ascertained by capitalizing the net operating income at overall cost of capital, which consider the constant value of the firm. The market value of the equity is ascertained by deducting the market value of debt from the market value of the firm. Formula for NY approach equal to V equal to EBIT divided by K. V means value of firm. EBIT means earning before interest and tax. K refers to the overall cost of capital. Next we discuss about the EBIT and EPS analysis. EBIT and EPS analysis gives a specific uh, gives a scientific basis for uh, comparison among various financial plans and show way to maximize EPS. EBIT means earning before interest and tax. EPS means earning per share. Then we discuss about the leverage. The meaning of leverage is uh, increase mean for accomplished some purposes. It means that the purpose of finance operating leverage and composite leverage. Okay, so first we discuss about the operating leverage. Operating leverage may be defined as the tendency of operating profit to vary with the sales. It means that profit firm has pay fixed cost regardless of volume of output or sales. The operating leverage is consisting of amount of fixed cost, contribution of margin, and volume of the sales. Next one is an financial leverage. Financial leverage may be defined as the tendency of rescheduling net income to vary of operating a profit. It indicates the changes that the task plays in the taxable income as well as a result of change in the operating income. Then it is then another one is a third one is a composite leverage. The composite leverage is also called as a combined leverage. Combined leverage formula is operating leverage into financial leverage. Okay, this is the formula for composite leverage. Composite leverage expressed the relationship between the revenue on account of sales and contribution or sales of variable cost. At the same time, considering the taxable income also. Uh, thank you for watching.